Okay.
And this is going to be sent out to Vint only investors. So
Sure.
it's just as I mentioned, it's great to hear from founders when it's not just fundraising time and to get
Yep.
an update background on the company a little bit. So I had sent a few questions to you, but I thought if you can just kind of help repaint the picture for us. It's been a few years since our initial
Yep.
investment. Our first investment in Vint was in October of 21. So, um, and it's been,
Sure.
um, we've been appreciative of quarterly updates, but today we'd like a little
Yep.
color and information around those updates and kind of get a better feel for, your burn, your trajectory, this I'll call it a pivot right now, but that's what I want the color around is to truly understand is it a pivot and how are things going? So I'll
Sure.
leave it at that and let you take it from there.
Yeah, definitely. Let's just start back in 2020 and like talk about what the company has been at each point of investment and where we are today. So, the original insight for me into starting Vint was fine wine as an asset class is highly economically inefficient. Um, Meaning you could acquire a bottle of wine that was worth $1,000 in the US for 800 in Europe. And if you minimize transaction costs, you have these arbitrage opportunities. I've always been a trader of sorts, prior to starting Vint, was at a value investment fund and thought, hey, this is a very antiquated, interesting market to compete in. Um, in your investment in October of 2021, at that point in time, we had gone through a 9-month process to get SEC qualification to release thematic collections, which I know a number of your investors are investors in those collections, direct to retail investors, both accredited and non-accredited. So we built the online platform and, anywhere from 1 to 10 times a month, we were releasing collections direct to um, investors. So in October of 2021, I think we had probably done like 10 offerings and they had all sold out pretty quickly. And we raised that round. The next round, October of 2022, was so we ramped really quickly. We went from 10 to probably 50 offerings on the platform, growing really quickly. One offering a week and to do an offering, some background there, we would source the assets, file paperwork with the SEC, and then put the offerings live on the platform for investors to buy into. From Q2 2021 through um, basically November of 2022, the SEC was giving us the thumbs up every like within 3 days. We would file an amendment, we would get the okay, and we could operate this highly efficient turning model. In November of 2022, right before my wedding, the SEC decided to send us a comment letter, which was basically asking a number of questions related to our offering document. Our offering document had been the same thing for 2 years, but sort of out of nowhere, we got this, you know, I guess, you know, interesting, I guess. Why did this happen now when nothing materially has changed over the last 2 years? From November of 2022 through December of 2023, so for about 12 months, 85% of our days were in comments with the SEC going back and forth. The former SEC commissioner is one of our advisors, Dan Gallagher. I started talking to everybody within the sort of Reg A plus, which was the regulation that we were operating these offerings under, and everybody got hit with these comment letters, which Rain, this isn't like an action letter. This is like, oh, explain this. I remember at one point in time I was and um it was uh a difficult time because it was inconsistent, i.e., we didn't know like when we were or were not going to get comment letters. And there was no visibility into if they were going to respond in 1 day or 30 days. So we kind of had to basically sit on our hands and we would try and file as many new offerings as possible so that when we did get the okay, at least we could do a lot of offerings.
Had you
So,
already secured the assets before that, so you had to hold those assets while all of that was going on?
yep. So at one point in time, so that we can look at that Reg A business and probably point to a number of things that were broken about that business. That was a big one where the more that we grew, the more risk that we ended up taking on in the form of, call it inventory risk, because we had to go and source the assets. We went to the SEC and we're like, hey, can we identify a theme and then source assets after we've raised the capital? Like every other investment firm would do. And they said, no, you can't do that. So we tried a number of, and it's all fine when you're getting a response from them in 3 days, and you can operate a really quick negative working capital cycle where you acquire the assets, you pay them 90 days later, and you're able to, raise the capital behind it, and it's nice. But when you end up getting delayed 4 months, and now you have a bunch of cash tied up in wine because you haven't been able to quickly flip the collections through the platform. Yeah, it was a drag on the balance sheet, which doesn't exist anymore. So, in naturally as a startup, things happen. You have to adapt. So after we had gotten held up for call it 2 months, I was like, we need a new product. So that's where we rolled out our Reg D diversified offerings direct to accredited investors. So
2020, mid 23-ish?
yes, March
Right. Thanks.
2023, we did our first Vint. I think it was a whiskey one. Rare whiskey one. We followed that up with Vint Diversified Offering one, Rare Whiskey two, um, direct to accredited investors because Reg D 506C does not have the level of SEC oversight and scrutiny. And we were seeing decent uptick there through the platform, and it was probably end of summer after dealing with sort of continual comment letters where we made the call to um, announce that we were going to be sunsetting the Reg A Plus platform because um, I can speak to I can blame the SEC, I can blame all these people, but ultimately it was um, I didn't see a way that that model was going to scale to $100 million a year in volume because you kept increasing risk by having to acquire inventory. The average check size was like roughly 4,000 across a number of different offerings. And just doing the math on that was like, this won't scale to do hundreds of millions of dollars a year in volume. And it was a tough decision. You battle sunk cost bias of we've built this tech platform, we've done all of this to enable it, but I have no doubt in my mind that that was the right decision. And so let's just put us here at the end of 2023, and we've now sunset this business unit. We have a pretty nascent Reg D to accredited investors, and we're like, we need a new channel. And at this point, track record has been built. We had recently hired somebody who had worked at an independent broker dealer who was
Before you get to that, can you give me a rough idea? Each of the offerings under Reg A, what was the average size of that? And then in March of 23, when you went to the Reg D, how big was one offering in comparison to what it was at Reg A? Just so I get an idea of each offering size.
Yeah, Reg A, the average offering size was 100 grand. Reg D was 1 to 2 million.
Okay,
So um,
thanks.
yeah. Um, and if we want to look at um, sort of GMV, gross merchandise value, gross investment volume, which encompasses invested volume and turnover through the market. Actually, sorry, I need to take a 9 month step back. At the same time we released the Reg D diversified offerings, we launched the Vint Marketplace. That's a like pretty material to the story here, but the Vint Marketplace, online e-commerce marketplace where we're selling wine and spirits to people who are going to drink and consume these, or collect them. So um, that was the response to the SEC delaying us was Reg D and the marketplace. So two new products because we kept getting delayed. And the Vint marketplace started as a landing page. The first month we did 15,000. Second month we did 40,000. We built a platform around it in a pretty cost efficient manner, 100,000 last month. So sort of 18 months in, we did just under 1 million in sales volume through the Vint marketplace to wine collectors, consumers. So
Nick, are you on Vint Marketplace? Are you utilizing any of the So let's say the Reg A offerings that you had, are you guys selling any of your sourced um, spirits on there, or is it only a marketplace of the public and you're taking a cut of it?
both. So there are both managed assets and third-party merchants that list on the Vint marketplace. Um, and that business has been growing really well. And let's kind of jump back to the end of 2023 here. So we've sunset Reg A, but we have the Vint marketplace that has been growing sort of 20-ish% month over month growth since we had launched it. And we have this accredited investor base. And at that point in time, high conviction around the Vint marketplace and continuing to grow, but I would say low conviction around scaling an online accredited investor platform because um, some people would say, okay, interest rates have us, but ultimately it was just too expensive to acquire customers, and we're like, okay, we need a new channel that's going to be larger investors because larger investment volume, you can spend more to acquire that customer. And we started in the independent broker dealer space. So we hired somebody from the space. She was highlighting like the substantial volume of real estate investment in this space and oil and gas investment. And we did a massive deep dive. We probably talked to 100 people in the space to just understand the dynamics. And we basically got everything we needed, a PPM, third party report to go to market there. So took about 3 months to get everything ready to go to market. We were in market in March. Um, and over this time, the marketplace is continuing to grow. The broker dealer space,
Can I interrupt a minute? Can
sure.
I, sorry, cut in here? I, I guess I'm unclear about you referred to real estate and oil and gas, and what does that have to do with this?
The independent broker-dealer space, which we viewed as a potential distribution channel, was distributing real estate and oil and gas deals through financial advisors. So they were familiar with alternative assets like those, which was core to our bet that this would be a channel that we could gain distribution within.
Okay.
Yeah, so like 1031 exchanges or multifamily funds, oil and gas, like tax advantage deals, ton of tax stuff that flows through this independent broker dealer space. And sort of you have everybody from like a three-person independent broker dealer firm to like LPL. LPL is an example of this. Basically, all of these broker dealers outside of the big wirehouses. So, LPL, Cetera, are some of the big ones. And so when we were working in this space, we were having a lot of conversations and we got connected to a firm up in and one of the big developments with that space was we were working with a law firm and they were like, hey, we think this offering could be QSBS eligible. QSBS, also known as qualified small business stock, is an incentive the federal government has put in place, whereby if you hold stock in a small business, which means under 50 million of gross asset value within a certain industry. So it excludes like doctors' offices, excludes um, investment funds, it excludes um, industries
Consulting.
and yeah, consulting industries in which the enterprise value of the business is dependent upon like the skill of one singular person. It excludes all of those, but they're like, hey, you're effectively operating like a wine and spirits trading business. One could look at it as retail, and people are investing in that. We think it has a strong case to be QSBS eligible. So that was part of the core pitch for which the Vint diversified offering too was, hey, potential QSBS eligibility. As we were having conversations, we were getting connected to other people within the QSBS world, which is very small. A lot of people don't know about this, despite and you know, now we've probably talked to 50 plus CPAs, tax attorneys, and their knowledge ranges from, they really, really know it to very, very surface level understanding of QSBS. So we got connected to this like multifamily office style firm, and they were looking at the Vint diversified offering too. And they're like, oh, this is interesting, but we have this current problem, and we think you might be able to help us solve it with this offering. One of the criteria to get the QSBS tax advantage, which is no federal income tax on the deal. Also, most states observe QSBS. They were in Massachusetts. Massachusetts observes QSBS. But you have to hold the stock for 5 years. They'd only held stock for 3 years, and they were about to be making $30 million. And it was not going to be observed by QSBS. And they're like, oh, we need 2 years to hit QSBS. There's this thing called a 1045 rollover or QSBS rollover. Um, would we be able to do that into your deal? Um, and number of reasons you can't do that into like the deal that we were doing, but we are like, hey, this is a pretty interesting problem. They're getting taxed nine, I believe $9.9 million, and they just have nowhere to put this money for 2 years. That's all they need. It's like a 2 year bridge. So my colleague Brady, who at this point is one of the foremost experts in QSBS rollovers because that's all he's been doing, reading, and thinking about for the last 9 months. Um, he was like, let's see what we can do. So we chatted with a number of different lawyers, everybody from kind of like the academic QSBS people to like M&A lawyers, and ultimately ended up working with DLA Piper to structure a this partnership program to solve QSBS problems for people. So um, I'm going to take one step back and kind of pick up where I left off on the independent broker dealer space. Kept selling through there. It was very expensive. I'll be pretty candid. It was like a somewhat soul-sucking experience to work in this space that was um, uh, so pay to play and so transactional that it was it's conferences, it's working with these wholesalers. There's like 8 levels of middlemen whereby we took a step back and we're like, it's um this is getting quite expensive. Yes, we've raised about 1.5 million through that channel, but it's very expensive. The sales cycles are 6 to 9 months. Um, and we were observing challenges with this. Um, so meanwhile, Vin Marketplace is continuing to grow behind the scenes, but I'm primarily focusing on the evolution of the investment side of Vint. This QSBS thing, we're like, okay, let's get a product, let's get a partnership program structured, hit all these different criteria required for QSBS. And um, we started kind of building a distribution network and kept running into these two problems. So um, just pure kind of standard startup pitch here. What is the problem? If you sell QSBS before 5 years, you're going to be taxed. If you sell it on year four, 11 months, 29 days, you're going to get taxed. The only solution to that would be a QSBS rollover. Another problem, if you make more than $10 million, so QSBS taps out at $10 million, you're going to get taxed on the excess. A QSBS rollover is a solution to that. You can do a QSBS rollover into any other qualified small business stock. So angel investments would kind of be or starting your own firm are the two options. You only have 60 days to do a QSBS rollover. So you need to have a deal there right now. And you're also going to be taking on substantial risk. Most startups go to zero. So if you make this money and you're basically just looking for a bridge to hit 5 years, do you want to put that in an early stage startup where the risk of going to zero is material? No, that's why a lot of people haven't done it. So we structured this program to be liquid, i.e., if you need 2 years, we can structure it to be liquid at the end of 2 years. Um, Downside protected. We operate a wine and spirits trading strategy that we've done for the last, 4 years. And the single biggest drawdown within fine wine over the last 124 years is 34.9%, which was in 1949. So it's pretty well downside protected. And we acquire assets at a discount. So um, now, today, somebody who exits before year five and is looking for, call it a 2 year bridge, or somebody who makes in excess of 10 million can roll over into the Vint Retail Partnership Program, and we can term it out for, 2, 3 years. Behind the scenes, we're running the wine trading business. wine retail business, and you get the incredible benefit of not paying taxes. That's the benefit. We guide people, hey, we're targeting low to mid single digit returns. But really the value here is we are the only place that is downside protected and can get liquid that you can do a QSBS rollover into. Um, and honestly, this decision has been made within the last like 2 weeks. Like from the investment side or capital market side of the business, we are now 100% focused on this. And I'll give some examples why. I'm flying to San Francisco tomorrow because I got connected with somebody who just sold their company, made $110 million. He put 50 million into trusts. He has 56 million that he's looking to do a rollover with. Potentially, he's not going to do all of it, but he's like, "Oh, I'm going to pay 20 million to California anyways in taxes. Why not just do a rollover here?" So we've started to build this distribution channel into founders and early stage employees, and honestly, venture funds who could benefit from this. So VCs are introing us to exiting founders. Tax and trust and estate lawyers have been sending us founders who are exiting. CPAs, not as useful, kind of painful to deal with, but sometimes occasionally we're getting CPAs introing us to founders, early stage employees, and LPs who could take advantage of this. Um, but the the rationale behind going all the way behind this strategy is one, um, we're solving a problem for somebody. I've spent the last 4 years selling wine as an alternative asset as a way to diversify your portfolio. Um, I can make a good case for that, but it's not solving a problem. It is totally selling a vitamin when somebody's in a vitamin shop that has thousands of options. There's so many alternative assets, and we're just competing for that, 20% of the portfolio that somebody might put into alternatives with some pretty large competitors. So solving a problem is, in my opinion, um, you know, it's just such an easier sell point, especially when there's this time crunch of 60 days. So that's one. Second is if you want to think about the economics of Vint, the supply side, i.e., the managed assets have a certain cost of capital or expected return associated with them. Um, when people are investing in alternative asset, they want sort of 10 to 15% type of returns. Um, that limits our ability to take transaction fees and earn additional revenue because we want investors to hit certain return thresholds. The cost of capital or the expected return for this person um, is zero because if they get their money back, it's like an implied return of 30 to 50%. And honestly, the math is truly the strongest argument for this. Um, but when somebody's expected return is zero, we're able to sort of 3x revenue based on that. So, like this is a memo that we share with people, which I think outlines the math here. And I'll share this memo with you all. But the the case to be made here is so strong, and that minus 35%, that's pulling the single biggest drawdown in the wine market over the last 124 years. um, but I guess where we are today as a business is capital markets focused on this retail partnership program, solving a problem for founders, early stage employees, and anybody who owns private stock and has an exit. And the Vint marketplace acts as the exit channel for these assets. And um, yeah, so that's the 31-minute story of Vint since you all invested in 2021 to today. So it's been far from linear, as I hope is somewhat expected in startup world, but I think we keep adapting. And today, um, I think today um, is the most excited I've been about where we are as a business, because of this product that we've created, and the highly um, complementary nature of the two sides of the business. This product in the marketplace. Um, I've said we're about on the precipice of breaking the wine market because we have a cost of capital advantage over everybody else. If the standard margin is 15% and we need to earn somebody 0%, uh, the market breaks. We just priced it at 10%. Nobody will be able to compete, and you take the entire market. I don't think that's um, yeah, I don't think that's uh sort of crazy thing that can happen here when we can just have every asset cheaper than everybody else because we have a massive cost of capital advantage. Because, like, if you think about it, a lot of people are using equity capital to finance their inventory, or if you want to take on capital to finance wine inventory, I don't know, you're going to pay like 18% today on that, and we're paying zero. So um that's I think that's why I'm excited. This model somewhat exists over in the UK. Somebody like a Berry Brothers, they manage 1.3 billion of wine. They're doing 300 to 350 million of turnover a year. Um, and the the company is sort of resting on, can we been reading a fair amount of Bezos recently. He bets on things that will never change. Are people going to want broad selection of wine? Yes. Are people going to want cheap prices? Yes. Are people going to want fast delivery? Yes. We're going to be the only ones with that here in the US because nobody else has a very creative way to finance inventory. So um, I will I will stop.
Going on this, as a founder, you need to make decisions that help accelerate your company. So I see the advantage to a QSBS rollover. I'm assuming the 5-year period doesn't start over when they roll over, and you kind of pointed that out. I just want to be clear. Okay.
Correct. You
Um,
keep
but
the
QSBS is also a tax law that could be changed tomorrow. And I know that that's a risk, but it's existed for a while and it could be for the foreseeable future. But I'm curious, I'll use the word abandoning the Reg D offerings that you have. Is it too costly to keep that out there just because if there is, a change in tax law, I know the marketplace is growing, but that's really my question is you always think about, what are the greatest risks today? And if that happens, what am I going to do tomorrow? So why abandon the Reg D? Is it too costly to, have a few offerings out there? Because taking them away altogether seems like a bigger risk, but I'm sure you've analyzed this. So
yeah. One thing that I've learned over this journey is like focus is incredibly powerful. Although the cost dollar wise might not be high for keeping a Reg D offering available on the platform, it ends up being high in, like, sometimes there's operational things you have to deal with. You have this thing that's sort of nagging in the back of your mind of, oh, should we be directing people to this? Um, I believe the risk of going all in behind this is um is worth the reward of pure focus around this singular thing. So and it doesn't mean we don't go back to it if things all of a sudden change, like we could spin up another one really quickly. But there will be a singular focus on the capital market side on this QSBS rollover product. Um, I tax law can change. Who knows what will happen? I can't control that. But I think everybody likes small businesses. So that's sort of, I guess, one reason I sleep at night. And
What
So
will happen to the current investors of the offerings that you've put out so far?
yeah, we're managing the assets. We'll be selling them over time. The wine as an asset class, you can look at Livex indices has been down over the last year and a half, 2 years. So we haven't looked at that as a viable time to sell. So yeah, we're still managing those assets, looking for time to sell. And honestly, as the Vint marketplace grows, we will be able to. Right now, we're a price taker. If we take the market, we'll be able to be a price maker and we'll be able to earn greater returns. So as the Vint marketplace grows, we'll be able to exit more and more assets. But the market has been down, so we're um, yeah.
on a
We have
QSBS,
finan-
go ahead, Andrea.
we have financials from Vint that we've invested, the entity we've invested in. Is there someplace else where there is our financial reports um, of the offerings that other people have invested in? You know what I mean? Like, what's the total value of the wine and spirits and different?
Yeah, the
Uh,
the Reg A plus collections, there are SEC filings where like we semi-annually and annually we file those that have audited and unaudited financials, audited on an annual basis and unaudited on a semi-annual basis. So those exist. I can pass along the links, and then for Reg D investors, we send out a statement.
But do you
so those don't
combine them
require
into a
it.
total value anywhere for on, you know?
Uh,
Okay.
Going back to an earlier question about runway, so what are your capital needs going forward?
22 months of runway. If we roll over 20 million in the next 2 weeks, we will be profitable. So, but right now, 22 months of runway.
The Reg D offerings, or you sell some of those assets inside of an offering opportunistically, correct? How then you haven't held on to it for 5 years. So do you have to take the capital that you use to sell and put it back in so it's still in that box? Okay.
Reinvest. Yeah, you have to hold the
Yeah.
stock for 5 years in the Reg D ones. So we are reinvesting. The Vint Diversified Offering 1 and Diversified Offering 2 have recently hit about 100% annual turnover. So turning the portfolio on an annual basis, which is pretty exciting.
Hmm. I have
Meaning
to ask or take
all
you
the
back.
wine that you invested in has been replaced with other wine. Is that what I'm interpreting what you
On
said?
the diversified offering 1 and 2, yeah, like the run rate monthly volume is 100% turnover. So yeah,
So I have to take you back to 2020 when you were first doing your first pitch and you talked about how big the market is. This QSBS rollover, I don't know how you define that. Um, we've been angel investing, some of us on this call for decades, and yet to have a company exit in sooner than 5 years, or at least I haven't in my portfolio. So in my um, filtered eyes, there doesn't seem to be a big market. Now you're dealing in a space that nobody else has, so obviously your total addressable market is you're the only guy going after that. But I don't know if you've penciled out projections. Obviously, one deal tomorrow for $20 million changes the scope of things, but I, I, I'm curious if you have an idea of, projections of how big is this space?
In the last 60 days, we have seen 147 million and $950,000 worth of potential rollover volume. $150 million in the last 60 days.
Is that public information reportable somewhere,
No,
or
no, that's like we've talked to these people. They've been referred to us. Uh, yeah. So that ranges in size from 60 million down to 200K. Average rollover size is about 10 million. Um, and that's just average rollover size. Like for example, the individual that I'm going to meet with tomorrow, like we have him in here for 20 million, but he has 56 million that could be um, hypothetically rolled. So we, whenever we talk to CPAs and lawyers, they seem to see these on a um, 1 to 3 times a month basis. Um, I guess you can look at like Crunchbase data as well if you're interested in market size. So like Crunchbase, I've got a bunch of venture firms of like a filter created where if somebody exits, I'm being notified. I can get connected to that venture firm who can connect me to that founder and we can chat. So um
that's helpful? That's like a scalable sales funnel for you, not just that you need to know everybody that's having an exit, but that's
yes, it it is. This is literally what Goldman Sachs Asset Management does. I was talking to Montage who led our seed round, and they're like, "Oh yes, that's what Goldman does to try and get in touch with these founders." I've got a pretty good venture network now. So this individual was actually introed from First Round Ventures, who's really high quality venture firm, and the nice thing about that sales funnel is that there's minimal red tape. You get sent straight to the decision maker. You're not talking to CPAs, tax lawyers, financial advisors, their wealth manager who's going to have all of like all of these conflicting interests. Like the wealth manager wants the dollars to manage themselves. Like even though we'd be saving them substantial money, they want the 1% management fee on it. So it I ultimately think that will probably be the best way to get in touch with these founders will be through venture. And I've started to get it pretty involved in like other founder communities and just be value additive on QSBS things. I'm not selling, but if you say, hey, I'm exiting and I've only held for 3 years, it's like, well, here's a solution. So um, the um, the repeatability and the ability to be doing $250 million a year in this, like, is I can see how that gets done. I can 100% see how that gets done. And the network will only grow. And yeah.
do you see Vint Marketplace going back to the boring recurring uh, revenue. $1 million last month. What does that mean for revenue for you? What's your take on that million?
Yeah, so gross margin on that is about 12.5%, gross margin figure. So
And I'm not a wine connoisseur, but if you look on your marketplace, it's phenomenal. I mean, I don't know that I could come up with a wine that doesn't exist on your marketplace. So it's got to be gaining popularity. Where is the trajectory? Because I look at your discussion on this as the QSBS being the cherry on top, but is the other part when you say remain focused, do you want to sell the marketplace so you can focus just on QSBS? If so, or I don't know what your thoughts are on that side of the business.
you need the marketplace because
Oh,
without the
good point.
marketplace, you
Yeah.
can't be selling the inventory and
Oh
be
yeah.
selling
Yeah.
at a
Yeah.
loss. So the two are very much
Complement.
synergistic. Uh, what was I going to say? So one thing that you notice about the Vint marketplace is yes, there's a lot of supply, but a lot of it says pre-arrival. So it ends up taking like, and this is commonplace in the wine space. It ends up taking 12 to 24 weeks for people to get wine because the merchants that we're working with are all in the UK and Europe. So you buy the wine, it kicks off this process of bringing it into the US. A number of people compete with us on pre-arrival wines. When QSBS rollover works, nobody will ever buy pre-arrival wines again because people buy pre-arrival because typically it's cheaper. Um, and you'll buy like a singular case. Um, However, when presented the opportunity to receive something in 3 days or 3 months, nobody has ever chosen 3 months. That's where I say this breaks the market is that you take 20 million, go acquire that, bring it into the US, all of a sudden you're better priced than everybody in the pre-arrival market, and you get it in 3 days, not 3 months. And all of a sudden you've broken it.
So the marketplace, how do you, what do your sales numbers look like if it was 1 million last month? What is it a year from now and 2 years? Um, I know it's dependent on the QSBS as well. That's what you're saying.
Yeah, it is. It's somewhat a function of supply. So this year, I actually just pulled this number. Last 12 months, we've done about 12.5 million in volume through in GMV at the Vint marketplace. Um, that'll be up um, at least 3x over the this year will be up 3x over last year. Um, I think another 3x is certainly possible the following year. And then another 3x if QSBS works. Yeah,
Okay.
I think this
Okay.
could triple,
Those
triple. And you're
those
doing,
projections become nearly impossible depending upon your QSBS sales right now. Because, if you get a $20 million pop, then you got to buy all that. Okay. All right.
yep, it, I'd put hopefully tomorrow goes well. My current odds are like 50-50. And that's me trying to not get my hopes up. But yeah, I mean the business gets profitable. The QSBS rollover presents like a 6.2% ARR creation on investment volume. So a twenty million dollar rollover, we'd be doing about 100K a month and very, very, very high margin recurring revenue, um, and then additional transaction fees. So,
What kind of cost you mentioned fees? What are the costs of the program and who all gets a cut? You mentioned VC firms and all these other, broker dealers that you're working with to drive this business. I imagine everybody wants a piece of that. So what does that look like?
Yeah, so we're not working with broker dealers anymore on this. So the venture fund, they just want to be value additive to their founder. Uh, in the case of the venture fund, the founder just made 100 million. The venture fund probably just made 50 million. They're happy. They just want to help their founder, and that's nobody gets a cut today of the economics. So they just want to help their founders out, and this is, you know, a potential opportunity to on every $10 million of exit value, they can save at the lowest amount, 2.38 million. At the high, it's like 3.6 million. So we've offered cuts to people. They say no. Right now, all of that revenue comes to us and it's quite high margin.
What kind of regulatory scrutiny are you under for making sure that you're following all the protocols for QSBS and whatever that looks like? Because I admit it's mysterious to me, but like what keeps you in compliance with QSBS rules, and how are you evaluated, or what kind of oversight is there on that?
A 24-page legal memo is what I can point you to about why this works from DLA Piper. So they've outlined all of the reasons why this works. I'll also call out if somebody was concerned about QSBS eligibility, we have insurance partners that will insure the tax risk. So tax insurance for QSBS exists. So it's typically like 2 to 5% of tax liability is the insurance cost.
Is it safe to assume that the burden of eligibility you guys put back on the customer? Meaning,
Hmm.
we're setting it up to be eligible, but whether or not you qualify, your documents would, I hope, clearly state that's up to them to apply. And um,
Yep. Because we're just a business partner. You're running a joint venture with us. You create the C Corp, you fund the C Corp. We take a small partnership interest and, pass through active business conduct through that partnership to them. As I said, this is all out. I can pass on the DLA memo as well, because that is a common question where people say it sounds too good to be true. Is one of the points of feedback that we've gotten, and we just pass them on the stuff. So yeah, but ultimately it's on the customer.
is have you looked at the private equity space? Independent sponsor models set up their deals, and to me, it seems like they might exit sooner than 5 years on some. Is that a
Uh,
marketplace you've searched?
Not enough.
Okay.
Not enough. Yeah, that would be if I even ask from your investor base is private equity is one space that I think is interesting. And yeah, any sort of CPAs, tax advisors that do QSBS work. Just building this network, this massive network, so that everybody knows, hey, this is an option. And then it's just block and tackle. Drop off a bottle of wine once a quarter to them. Hey, just keeping you top of mind here. If somebody has this problem. Um, yeah, but private equity is an interesting one to me that we talked to some bankers yesterday because they see a ton of deal flow and just making sure that they know this is out there. Uh,
Okay.
yeah.
Awesome. Well, thanks for repainting the picture. Um, as you said, it hasn't been a straight path, but this provides additional information to your
Yep.
updates. I don't think can provide all this color. The surprise I have to me is that the independent brokers, that you're not, at least continuing some discussion in there, but I think you've indicated it's about focusing on something. Because I thought you've implied they don't really have this as an alternative market, to be able to do this because there aren't people that do that. So is it safe to say that if QSBS laws change, that might come back into play again? But right
Sure.
now it's about focus.
Sure. We had a very similar discussion when we were talking about should we keep Reg A. It's like, oh, we could keep
Hmm.
Reg A doing it in the background. Um, you know, there obviously every situation is different, but I have zero doubt in my mind that it was the right decision to say, we're done. We're not doing this anymore. And like cut it right now. So, every situation is different. You have to underwrite um, the um, the dynamics of every decision. But certainly have learned from past experiences. But
So nearing
yeah.
the end of 2024, are most of your Reg A offerings already sold out, or do you still have half of the inventory or three quarters or
No, I mean the strategy there was like offer market beta, like give people exposure to wine and spirits over a 5 to 7 year horizon, three to
okay,
seven year horizon. So we're still a bit early in the hold for some of those, but
okay.
expect the pace of that to ramp each subsequent year as we hit those kind of maturity windows.
And those are revenue for you as well, because you took a stake in each of those offerings yourself.
Yep, yep. We are one of the top five largest investors across all of our offerings.
So that'll continue to generate money for you guys as you sell out of those. Okay,
Indeed.
thank you. That's important to know.
Yeah.
It's a good
Um,
annuity to have.
yeah, yeah, it is. Um, yeah, if there's any other questions that people have, I'll pass on I'll pass on three pieces of QSBS info for this rollover, a 2 page memo, a 40 page white paper we wrote, and the DLA, so people can pick and choose how much they want to learn.
That'd be appreciated. Thanks, Nick.
One
Great.
one last question that I have. So if you're selling these QSBS rollovers, are these now completely outside of the SEC purview?
Yeah, we're just a business partner. So there's no like, we're not selling securities in any way. We're just
Okay.
somebody has a C Corp. We enter into a joint venture business partnership and we're running a wine retail company with them.
Okay.
All right.
Awesome. I'm gonna stop.